After a rally of over 136% over the past year, Netflix shares are pulling back in the after hours after reporting Q2 earnings that missed the mark on some fronts. We'll get into the financials. We'll take a look at all of the different metrics that the company provides for you, and then we'll come over here and look at this from a technical perspective. Is Netflix creating a great buying opportunity? Is this the end of an epic rally that shares of Netflix have been on over the past year? What is going on, investors? Hopefully guys are doing well out there. Time to talk about Netflix. Like I said, over the past year, up 136% year to date, up just 61%. That's after the company reported their Q2 earnings. After the bell, revenue coming in at $8.2 billion. That was just, and I say just 2.8% revenue growth, and it missed expectations by about $100 million. Now, the company did surprise to the upside on their global streaming net paid additions. This is essentially subscribers growing to over 238 million subscribers, or about 8% growth year over year. That was nearly 5.9 million net additions to that side. Now, the company came out in the after hours and said that the upcoming Q3, Netflix used to put this on the screen, used to put this in writing. Now they're more or less telling you the fact that the upcoming Q3 forecasts for subscribers should be roughly about what you saw in the most recent quarter. That had some investors disappointed, as they thought maybe we'd be on kind of an acceleration cycle with global net paid additions. But nevertheless, pretty solid results from the net paid addition side when it comes to Netflix. Now, other things that we're seeing here is just strong revenue in the most recent quarter, coming in at close to $8.2 billion. The upcoming quarter, so the forecast is for $8.5 billion. If you want to know where Wall Street stood in that, they were a tad bit higher. In fact, close to $8.68 billion. The low end estimate out of 29 analysts was closer to that $8.45 billion mark. Now, understand, the company did just miss its expectations in the most recent quarter, so this might not be an evidence of sandbagging, and it's just the fact the company is not meeting expectations when it comes to that revenue growth. That would still represent the $8.52 billion in revenue for the upcoming Q3 would still represent 7.5% revenue growth. We'll get to the rest of these numbers when we get to the full financials. Now, the other important thing as it relates to Netflix is their different geographical regions as they break down. Revenue side in North America coming in essentially in line with where you were last year. But again, very strong last 3 months as it relates to net paid additions. The strongest number on record here for Netflix over the past 4 quarters. Pricing, however, falling where we've been over the past 3 quarters and just up fractionally where we were a year ago. In Europe, Middle East, and Africa, again, very similar to the United States, similar revenue number, very strong net subscriber number at 2.43 million, a number that's only eclipsed by the Q4 number that we had. But unfortunately, an actual decline on the average revenue per membership as Netflix has rolled out that ad-supported tier, and a tier that if you are going to share passwords, there is a limit on that. Some of those things driving down the average revenue. In Latin America, also very strong revenue number, very strong net paid addition. In fact, the highest that we've seen since Q4, but similar story. Our average revenue per membership not able to really drive that higher. And finally, Asia and Pacific, decent revenue number, but in this region, we're used to slightly stronger growth when it comes to net paid additions. In fact, the just over 1 million paid ads is underneath any number that they've produced in subsequent 4 quarters. On top of that, your average revenue per membership also down in that case. When we come over here and look at his financials, look, there's a reason why Netflix trades at a premium. They're at 42 times earnings, depending on what earnings estimate you're looking at. Price to sales, price to pretty much anything when you compare it to Warner Brothers, when you compare it to even Disney these days, especially if you strip out Disney's theme park business, any of the media companies, not a lot of them, in fact, almost none of them trade at a premium valuation. One of the reasons why is Netflix does do a nice job maintaining some cost controls, marginally higher revenue year over year, which we talked about. Marketing costs did tick up over the last year. However, your technology costs slipped down, and they were able to drive down G&A cost as well. Slightly higher revenue driven by cost controls led to stronger net income, not only year over year, but sequentially quarter over quarter as we ticked up to north of $1.8 billion. You flow down to a net income number, you're close to $1.5 billion. That was very close to where we were a year ago on a quarterly basis. Coming down here to the balance sheet, company doesn't have a whole lot going on here. They've got plenty of cash. They do have some liabilities here sitting on the debt side, but when you produce this much positive operating income, despite the interest expense of $174 million per quarter, which is about the run rate the company is on when it comes to the debt payments, they have plenty of cash to cover that. Come down here to cash flow, paints a little bit different story, at least when we look at things sequentially. Quarter over quarter, we saw some deterioration in cash flows, but when you stretch it out to a year over year view, you are up considerably off of the $1.5 billion worth of net income. You had nearly $1.5 billion of positive operating cash flow. Now, the company is putting some of that cash to use by repurchasing the common stock on a stock that is up 61% over the past 7.5 months. I don't know if that's the best use of cash, but when the writers and the actors are on strike, maybe there's not going to be a whole lot else to spend this money on if that maintains itself. Those are the financials with Netflix from a technical perspective. Those of you that follow our Friday Fang Stock Recap show, we've been looking for this gap to fill that was created on the chart, I believe, after an earnings result between about 450 up to 505. The stock almost filled this gap, got about halfway through, and then obviously we had the after hours earnings result and the stock is pulling back. Now, in a vacuum, the stock is still in a beautiful uptrend that has essentially gone unchanged since May of 22 of last year. You are making higher highs, you're making higher lows until that trend reverses itself. And what would a trend reverse itself look like with Netflix? It would be some kind of break of this bottom purple line. In the shorter term, you'd really have to get pretty far south of $400 per share, maybe into the $370 region to have there be some concern that the trend was open. More technically, this is just a sign of how far stocks have run year to date. You'd actually have to pull down to these lows that you made back in May earlier this year, close to $320 per share. And while it seems like a long ways away, a stock that has made this type of move off the lows is due for some pullbacks. Probably the very first area that looks really interesting is right around the $400 mark. Just south of that would be interesting. You do have an area of support there from a longer term consolidation perspective. And also this purple line has been holding. Anytime you have two areas of support meeting one another, that is an excellent place to put a buy order and have a stop loss set just underneath that, because you better believe if not one but two areas of support break, well, the stock is probably heading much lower. In the shorter term, Netflix shares likely going to continue their retreat, as we see in the after hours, stocks down about 5%. Hopefully, guys, enjoyed today's video. We'll be back with Tesla later today. Good luck with your investments.